Jackie, I've been of the view that inflation is transitory in the United States, and this is actually the last of the big CPI numbers because it's the end of the COVID inspired negative CPI readings from last year, right? So March, April, May of 2020, CPI in the U.S. was negative because of COVID and the shutdown. So now year-over-year comparisons are really not worth much of anything. And I think you see that in the market reaction. The market reaction, whether it's fixed income, U.S. Treasuries, equities, the dollar, gold, nothing is really moving on this number. And I think it's because investors understand that the next number, in July, June's inflation will be more accurate because it won't have that negative number from last year. It will be much lower. And as we go through June, July, August, I actually think that the market will focus more on those numbers because it will tell us what kind of is in place after the COVID comparisons and after we're done with all the stimulus. Really what the market's trying to understand is what is the outcome post-stimulus, post-COVID recovery. And that's something that we'll get a better handle on in the next couple of months. A very important and valid point about shifting from kind of a staggered reopening where Asia, particularly China, reopened last fall, U.S. opening in spring, Europe about to reopen, Japan and EM following. That when we exit 2021 and enter 2022, we're going to be in a synchronized global recovery. I think that's very bullish for stock prices, particularly outside the United States. I think it's very bullish for commodity prices. I do not think it will mean sharply higher inflation because I do believe the supply chains that you mentioned and the production side will have by that time caught up. And so the supply demand imbalances and kind of blockages in the shifting production to the consumer will have been worked out over the next 3 to 6 months. I mean, after all, we are in this world where supposedly we have the digitalization of everything. And so I don't think we want to spend a whole lot of time worrying about commodity price pressures, which are a very small part of the CPI, the Consumer Price Index, when on the other hand, we have the digitalization of everything, which as we know is a major deflationary force in the world. And so that's one of the main reasons why I've been of the view that inflation is transitory and we shouldn't worry about it and we should stay invested in risk assets because people talk about commodity price pressures, but they seem to forget about the digitalization of everything. And the digitalization of everything is in the bulk of the economy. Commodity price pressures are dealing with a very small segment of the commodity of the economy, particularly as it pertains to the makeup of the CPI. And I also kind of feel like we're in a rolling reopening, as I mentioned. And so you have Asia, China's already peaked. China's growth is slowing. The U.S. growth will peak this quarter, in the second quarter. What's interesting, if you think about investing around the world, is that next year in 2022, it's quite likely that Europe, for example, will grow GDP and corporate earnings faster than the United States. That suggests to me that there's an opportunity in European equity versus U.S. equity. In Europe, again, by contrast, Europe has approved its joint recovery fund. None of the money has been dispersed. So that stimulus will come in the second half of this year and into 2022, 2023, and 2024. So Europe actually has a much cleaner, more well-defined and solid medium-term economic outlook, which is, again, something I don't think is at all expressed in the price of European assets. Then we have a setup where equity leadership can shift for multi-year period away from the United States to the rest of the world. And I, for one, think that that is a reasonable prospect.